Jon Cox, head of Swiss research at Kepler Capital Markets. Thank you so much for joining us. What do you make of those Nestle figures? It seems that actually they're bucking the trend and doing pretty well, performing pretty well in this slow market.
Yeah, no, totally. I think Nestle is certainly a class act. I think it's regarded as best in class by most of the investors if you compare it to its peers in North America and Europe. A cracking set of results, came in better than expected with organic growth in Q3, probably somewhere close to 7%. The market was looking for something closer to 6.5%. I think there's a couple of factors to point out. Obviously, everybody knows about the emerging market business growing 13% in the first 9 months of the year. Everybody knows it has a great position in emerging markets. But I think what Nestle does better than many other companies is their ability to grow in the developed world, and I think this is really key to the case. Everybody knows about the emerging market story, and everybody's hoping emerging markets are basically going to save many of these companies. But if you have the ability to grow in the developed markets, as Nestle did again, growing above 3% in Europe in Q3, that compares to a competitor like Danone not growing at all in the third quarter. It really makes the company stand out compared to its competitors. And go on, sorry.
No, you say that the company is standing out, and you actually believe that Nestle is the safest stock in the space, and yet you're actually changing your recommendation from buy to hold, and this is because you say there are currency headwinds and also cash flow improvements have slowed, and they recently terminated the buyback program. So does it mean that you're neutral, or you're actually a sell on the sector as a whole?
No, I remain a big fan on Nestle in terms of capital preservation. Now, if you're an investor, looking to weather this storm, you're not going to get too much downside in the case of Nestle, and that's why I think it's a very solid hold rating. However, if you're looking for a bit more excitement in that sector, I think there's better opportunities elsewhere. Now, being best in class, it means that your multiple compared to peers is much better, much higher than those peers. Now, on my numbers, and I think probably more or less on consensus, the stock is trading around 16 times PE next year already. Historically, that's a very high level. The sector as a whole is a couple of points below that. So I just think there's probably better and more interesting investment opportunities in terms of actually getting some stock outperformance rather than capital preservation. So that's the basis of the call. And obviously today the company is just cautioning a little bit on margin developments for Q4. I think that's something that probably more and more investors will keep an eye on. We've just finished the call with the investor relations team. They were saying, look, we don't necessarily see signs of a slowdown going into Q4, but we are cautious, and we think there'll be an increase in advertising and promotional intensity, and that's why we got this little bit of a cautious margin statement from the company going into the final part of the year.
Jon,
and I think go on.
Very quickly, you just mentioned that there are actually better values out there in terms of companies. This is a safe one. It's one of your favorites. Can you quickly tell me which ones they are, and then we'll get on to M&A?
Yeah, I think basically probably in terms of upside, both Danone and Unilever potentially offer investors more of an interesting investment. Danone should still be the fastest growing food company in Western Europe, if not the developed world, over the next couple of years. And then on Unilever, I think the management team there is doing lots of great work. And so I think both of these companies probably have more room to surprise on the upside. And I think this is the key to get upside performance. Everybody knows Nestle. It does what it says on the tin. This is why it already trades at 16 times PE, a very, very solid hold. But if you're looking for more upside, I think you can look at Unilever or Danone.
All right, Jon, we have to leave it there, unfortunately. Thank you so much, Jon Cox there.